Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Church & Dwight is a consumer products company built around a portfolio of trusted household brands, anchored by Arm & Hammer, but extending through OxyClean, Trojan, Vitafusion, Batiste, and Waterpik.
The company dates back to 1846, when John Dwight and Austin Church started the first U.S. baking soda business in Brooklyn. That Arm & Hammer franchise has compounded into one of America's most versatile household brand platforms.
What makes Arm & Hammer unusual is its scope. The brand spans baking soda, laundry detergent, cat litter, toothpaste, and air fresheners. A single brand equity extended across entirely different product categories.
The acquisition model is at the core of Church & Dwight's strategy. The company finds category leaders that are undermarketed, acquires them at disciplined valuations, and then invests to unlock their full growth potential.
OxyClean, Trojan, Waterpik, Vitafusion vitamins, each was a category-leading brand acquired over the past 2 decades and grown substantially post-integration. The pattern has been remarkably consistent and repeatable.
Financially, Church & Dwight is a reliable compounder. Organic revenue growth runs 4 to 6%, gross margins near 43%, and operating margins around 17%. Consistent, predictable, mid-tier consumer performance.
The dividend record is strong. 28-plus consecutive annual increases qualifies Church & Dwight as a dividend aristocrat. Steady cash generation from the brand portfolio supports reliable capital return year after year.
International expansion is the primary untapped growth lever. Only about 14% of revenue comes from outside the United States, significantly below peers, suggesting substantial runway as proven U.S. brands are rolled out globally.
The domestic business is deeply entrenched. Arm & Hammer products are in virtually every American home. OxyClean commands strong shelf presence and repeat purchase rates. These aren't growth stories, they're steady cash generators.
Competitively, Church & Dwight is a second-tier player by size, below Procter & Gamble and Colgate, but it often outgrows larger peers by focusing capital more efficiently on its narrow, well-curated brand set.
Matthew Farrell has been CEO since 2016, having joined Church & Dwight as CFO a decade before that. His tenure has continued the acquisition and grow model while delivering consistent margin improvement and capital efficiency.
The specialty products segment, serving animal nutrition and specialty chemicals, is small but strategically useful, providing manufacturing scale and product development infrastructure that supports the broader consumer business.
Key threads: acquisition pipeline and deployment of the balance sheet into new brand acquisitions, international revenue scaling, gross margin recovery trajectory, and whether organic growth sustains its historical pace.
Church & Dwight is the definition of a quiet compounder. Not flashy, not fast, but relentlessly consistent in building brands, returning capital, and compounding value over decades.
That's the company chapter for Church & Dwight. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Church & Dwight delivered a solid beat as the power brands held their ground. Q1 2026, EPS of 0.95 versus estimates of 0.88, a 7.9% beat. Revenue grew 4.8% to $1.47 billion. Arm & Hammer, Vitafusion, and Waterpik drove the outperformance. This is Charged Alpha. Let's break it down.
Church & Dwight is a specialty consumer staples company, market cap of $22.8 billion. The company manages a portfolio of 13 power brands spanning household products, personal care, and health and wellness. The flagship brand is Arm & Hammer, one of the most recognized consumer brands in America. Vitafusion gummy vitamins and OxyClean are the fastest-growing segments.
Church & Dwight's competitive advantage is portfolio positioning. The company focuses on categories where it can hold the number 1 or number 2 market share position, like laundry detergent, toothpaste, condoms, and gummy vitamins, rather than competing across every consumer product category. This focused model drives higher returns on invested capital than diversified consumer staples peers.
Let's walk the income statement. Revenue of $1.47 billion grew 4.8%. Organic growth of 3% reflects pricing power partially offset by modest volume headwinds in North America. International growth continues to be a bright spot, with markets in Europe and Australia delivering above portfolio average organic growth as the power brands expand distribution.
EPS of 0.95 beat the 8.8-cent estimate by 7.9%. The beat came from better than expected gross margin performance and disciplined SG&A management. Gross margin recovered modestly from 2025 lows as commodity cost inflation moderated in key inputs, surfactants, resins, and packaging materials.
Cash flow and balance sheet. Operating cash flow for the trailing 12 months is $200 million, lower than historical run rates due to working capital build supporting international expansion. Cash of $500 million against total debt of $2.7 billion leaves net debt of $2.2 billion, leverage that is higher than Church & Dwight's pre-acquisition target, but declining as EBITDA grows.
The dividend record is impressive. Church & Dwight has raised its dividend consecutively for decades. The company is approaching dividend aristocrat status, and management explicitly maintains the commitment to annual increases. The yield is modest at current prices, but the growth rate of dividend increases is consistent in the mid-single-digit range.
Full-year organic growth guidance was trimmed from 4% to 3%, the key concern in Q1. Management cited North American volume weakness as consumer trade-down pressure continues. Private label alternatives are gaining share in some core CHD categories, particularly in laundry detergent, where the Arm & Hammer premium has historically been moderate.
Wall Street consensus: 9 buy ratings, 7 holds, 1 sell. Average price target of 102 implies approximately 25% upside, significant for a consumer staples name. The buy camp is anchored on the long-term brand compounding story and the domestic manufacturing base that insulates CHD from tariff headwinds better than import-dependent peers.
Valuation: CHD trades at approximately 27 times trailing earnings and 23 times forward 2026 estimates. Price to book is 16 times. For a consumer staples compounder with consistent organic growth and a fortress brand portfolio, 23 times forward earnings is a reasonable premium. The premium reflects the quality of earnings rather than growth acceleration.
Barclays maintained overweight with a 110 target, citing the tariff-resistant domestic manufacturing base as a structural advantage versus peers who import more of their cost of goods. The company's vertical integration, manufacturing Arm & Hammer and OxyClean domestically, shields it from the import tariff headwinds hitting CL and KMB.
Bears focus on the organic growth guidance cut. From 4 to 3% may seem small, but it represents 25% of the incremental earnings growth that was priced into the stock. If consumer trade-down accelerates through 2026, 3% could prove optimistic, putting EPS at risk relative to current consensus.
Beta is 0.46, defensive consumer staples character. Forward EPS of $3.49 for full year 2026 puts the stock at roughly 23 times next year earnings. The valuation is supported by the quality of the brand portfolio and the track record of consistent mid to high single-digit EPS growth, but it is not cheap.
The bull case rests on 3 pillars. First, tariff resilience. Church & Dwight's domestic manufacturing of its core brands, Arm & Hammer, OxyClean, Extra, means input cost exposure from tariffs is lower than import-dependent peers. In a tariff-heavy environment, the company's relative competitive position improves.
Second, VitaFusion gummy vitamin growth. The adult gummy supplement market is growing double digits as consumers shift from traditional pill supplements to gummy formats. VitaFusion holds the #1 market share in the category and is expanding internationally. The margin profile on gummy vitamins is higher than household products, providing a long-term mix tailwind.
Third, Power Brands portfolio compounding. Church & Dwight's model of acquiring and growing #1 or #2 brands in niche categories has generated 15 to 20% annual EPS growth over a decade. The acquisition pipeline remains active, management has historically used free cash flow and leverage to add brands that fit the focused category model.
The bear case. Consumer trade down in staples is accelerating. Private label detergent and toothpaste are gaining share at a rate not seen since the 2008-2009 recession. If Arm & Hammer cannot hold shelf space against lower-priced private label alternatives, organic growth could decelerate below the 3% guidance floor.
Second, acquisition leverage risk. Church & Dwight has historically leveraged the balance sheet to fund brand acquisitions. Net debt of $2.2 billion at a company with $1.47 billion in quarterly revenue leaves less flexibility than in prior cycles. A large acquisition at current leverage levels would require equity issuance or dividend reduction.
Third, gross margin recovery uncertainty. Despite the guidance cut on growth, full-year gross margin recovery is still the consensus assumption. If raw material inflation re-accelerates, surfactants are particularly sensitive to oil price movements. The gross margin improvement assumed in consensus EPS may not materialize.
The consumer staples peer group includes Colgate-Palmolive, Procter & Gamble, Kimberly-Clark, and Henkel. Church & Dwight is the smallest of the major U.S. consumer staples companies, which provides more growth optionality but less economies of scale in procurement. The focused brand model outperforms diversified peers on ROIC, but underperforms in scale-driven cost categories.
Options activity was neutral. Put-call ratio of 0.95 reflects balanced positioning consistent with a defensive consumer staples holding. Income investors are selling covered calls at the 95 to 100 strike range. Hedgers are buying modest protection on the volume guidance downside.
CEO Matthew Farrell purchased 5,000 shares in March, a constructive insider signal. Insider buying by the CEO at a consumer staples company navigating a difficult macro environment signals genuine conviction that the EPS trajectory is intact. Institutional holders include Vanguard, BlackRock, and FMR.
Bottom line on Church & Dwight, a focused consumer staples compounder with tariff resilience, an insider buying CEO, and 25% upside to consensus target. The organic growth guidance cut is the blemish. For long-term quality investors who believe the Power Brands model can sustain mid-single-digit organic growth, CHD at current prices is attractive.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall